Welcome to the third module of IAS number 28, where we are going to explore the equity method of accounting. The equity method of accounting under IAS number 28 include the following. It involves recognizing the investment initially at cost, including any transaction costs as well. Subsequently, adjusting the carrying amount to reflect the investor's share of the associate's post-acquisition profit or losses and other changes in equity. So, for example, if you are acquiring your percentage of ownership, which is 25%, for example, in investee at October, so this means that starting from October up to December, if December is the reporting date, so you have a percentage of the profit that the investee generated from October up to December. So you have to recognize your share of the profit or share of the loss based on your percentage of the ownership and also considering the date of acquisition. So the profit after the date of acquisition is called post-acquisition profit or post-acquisition losses. So you have to recognize your share for this post-acquisition profit or post-acquisition losses under IAS number 28. The investor also adjusted the carrying amount of the investment for changes in the associate's equity, such as dividend paid or changes in accounting policies as well. Why? Because once the investee paid dividends to the investor, so the investor received part of the profit. This will result in reduction in the carrying amount or carrying value of the investment. And also, if the investee has some changes in the equity regarding the change in accounting policies, such as gain or loss, income or loss, for example, so the investor must recognize also the percentage of this profit or loss related to the changes in accounting policies. So as an example, company A acquired 30% interest in company B for $300,000. At the end of the year, company B reports a net profit of $100,000. Using the equity method, company A recognized its share of the profit, which is 30% out of this $100,000. So company A is going to recognize $30,000 as increase in the carrying amount of the investments in company B. The investor's share of the associate's profit or loss is calculated based on the percentage ownership in the associates itself. If you would like to calculate the investor's share of the profit or loss, so you have to multiply the investor's ownership percentage times the associate's profit or loss for the reporting period after the acquisition date. The calculated amount is recognized in two statements. Number one, the income statement or profit or loss, and then this will also increase the carrying amount of the investments in the financial position as well. So first things first, after calculating your share in the profit or loss, consider it as a profit or loss from associates in your statement of the profit or loss. And then consider this as increase or decrease to the carrying value of your investment in associates. So if you are recognizing share of profit, so this share of profit will increase the carrying value of the investment. If you are recognizing share of loss, so this share of loss will decrease the carrying value of the investment in the financial position. So continuing from our previous example, if company B reports a net profit of $100,000, company A has 30% stake on the ownership. So company A will consider and recognize $30,000 as profit from associates in the statement of the profit or loss. And also will increase this value to the carrying value of the investment. So the carrying value of the investments will go up because of this share of the profit.